Welcome. It's great to have so many people joining us for this Automatic Enrolment AE Business Advisor webinar. We're aware the spring budget's been announced, so we're grateful that you've taken the time out of your day to join us. My name is Lisa Morell, and I'm the Campaigns Manager here at the Pensions Regulator. Joining me today are my colleagues Andy Nichols, who is our Payroll Industry Liaison Manager, and Joe Turner, who is Head of Compliance and Enforcement. I'd like to start by thanking those of you who participated in last year's survey, as your valuable input helped us curate today's agenda to reflect your preferences. Today we'll delve into resolving common errors, where we'll explore the nuances of tax relief and qualifying earnings before walking you through a practical example of postponement. Following that, we'll address the topic of redeclaring, showcasing the updates we've made to our website to make the process easier and more accessible. And then we'll move on to discussing the assessment of directors before concluding with insights into anticipated future changes. After a 2-minute break, we'll then commence with the Q&A session. This will be your opportunity to ask us any questions you may have. You can start submitting your questions now and throughout the session by typing them into the box to the right of the video player. As we begin today's webinar, I want to mention a change in our approach. We've streamlined the slides and visuals so you can concentrate on what's being discussed. Don't worry, you will still get all of the detailed content afterwards for reference, as we'll be providing a set of reference slides and a useful links document available for download during this session, along with the recording in a few days' time. As mentioned earlier, there is also an opportunity to feed back on the session itself. The survey is now available at the top of the menu to the left-hand side of the video player. We would be grateful if you could fill this out before you leave, even if you can't stay with us until the end. I'd now like to welcome my colleague Andy Nichols to commence our first topic. Over to you, Andy.
Thanks, Lisa. As advisors, your support to employers is vital. As well as helping employers avoid mistakes, you may also be able to help them resolve any errors they do have. Some of the common errors we find when investigating compliance are using the wrong pension contribution tax relief method, not correctly identifying elements of gross pay as qualifying earnings and as pensionable pay, employer contributions during statutory leave, and the use of postponement. There are two types of tax relief used for employee pension contributions. They are net pay arrangement and relief at source, often referred to as RAS. Only one tax relief method can be used per pension scheme, so it is very important the right method is being used. Group personal pension schemes will always use RAS. Master trusts usually have a single method for all their pension schemes. For instance, Nest is always RAS, Smart and Now pensions are always net pay arrangement. Some may give the employer a choice, such as the People's Pension, which defaults to RAS but allows the employer to choose net pay arrangement. Please check that your clients are using the correct method. If you find any that are not, you should speak with your client and their pension provider and establish steps to rectify the situation, such as correcting the error going forward, working out how far back the problem goes, working out who is affected and what the amounts are, and a timescale for correcting the problem. Most importantly, communicate with affected employees. You may also need to include HMRC in your discussions, especially where net pay arrangement has been used instead of RAS or multiple tax years are involved. The employer should also notify TPR of an error so we are aware and can offer help if needed. Please do not delay in checking your client's payrolls and pension scheme requirements. Where net pay arrangement has been used instead of RAS, the employee will have received too much tax relief, and so is very likely to have underpaid tax. HMRC will look to the employer to fix this and possibly repay any underpayment. Where RAS has been used instead of net pay arrangement, there will be an underpayment of employee pension contributions, which the employee will need to pay, although we would expect the employer to make up any shortfall. It is very important that any errors are identified and fixed as soon as possible, as the work and cost involved can be very significant if not found early. Another error we see is where pay elements have not been correctly identified as being qualifying earnings, pensionable or both. Qualifying earnings are defined as salary, wages, bonus, overtime, commission, statutory payments, and any item of pay that would fall into these categories. The employer needs to review all their elements of pay that make up gross and determine which ones are qualifying earnings and which ones are pensionable. Some will be both. In conjunction with your client, please ensure that all the pay elements have been correctly classified. If you find an error, then, as before, please speak with your client and the pension provider and establish the steps to rectify the problem, such as correcting the error going forward, working out how far back the problem goes, working out who is affected and what the amounts are. It is really important to communicate with affected staff. Where some pay elements have not been correctly identified as pensionable, the employer, with your help, needs to look back over payroll records and calculate any underpayment of contributions and arrange to pay the amounts over to the pension scheme as soon as reasonably possible. Where the employee owes contributions, we would look to the employer to pay these, or, as a minimum, the employer should enable the arrears to be paid in instalments. Where some pay elements have not been correctly identified as qualifying earnings, the employer, with your help, needs to look back over the payroll records and reassess any worker to see if they should have been enrolled, or if already enrolled, then enrolled from an earlier date. Where they should have been enrolled or enrolled earlier, contributions will be due from this date onwards. The employer will need to pay over all the missing employer contributions, and we'd expect the employer to also pay over the missing employee contributions. Or, as a minimum, the employer should enable the arrears to be paid in instalments. Please remember the assessment at re-enrolment could also be impacted. These newly enrolled staff members will need to receive an enrolment letter and will have the right to opt out. This is a recap from last year's webinar, as we are still finding errors in the employer contribution rates for employees during statutory leave. For example, for employees on maternity leave, the employee pays contributions based on their actual pay. The employer pays contributions based on the pay the individual would have had were they not on maternity leave. Contributions are normally due for the paid maternity period. Employers may need support in calculating contributions for employees on statutory leave. The Money Helper website has more information on this. Based on your webinar feedback and the fact that some employers do make mistakes when using postponement, we're going to go through an example of how it can be used. But first, an overview of what postponement is. Postponement is where the employer can choose to delay the assessment process at their duty start date, for new age starters, or for those who meet the eligible job holder criteria. Postponement can last from 1 day up to 3 months. At the end of postponement, the member of staff has to be assessed. If the person meets the eligible job holder criteria at the end of postponement, they must be enrolled. If the person does not meet the eligible job holder criteria at the end of the current postponement period, then the next time they do meet the eligible job holder criteria, the employer can apply postponement again. But remember, if at the end of postponement the person meets the eligible job holder criteria, they must be enrolled and cannot be postponed again. A person will meet the eligible job holder criteria if they are aged between 22 and under state pension age, and their qualifying earnings are above the earnings trigger, which for monthly paid staff is £833 and for weekly is £192. It is important that you establish with your client the postponement rules they wish to apply and operate them accordingly. Here's an example. The employer pays their staff calendar monthly and has the following postponement rules in place. All starters are postponed from their start date for the maximum 3 months. Anyone who later meets the eligible job holder criteria is postponed to the start of the following pay reference period. So, using an example, Caroline starts employment on the 8th of February. She is 25 years old and has a salary of £30,000 per year. The Payroll Bureau, using the postponement rules set by the employer, postpones Caroline's assessment until the 8th of May. The employer or Payroll Bureau issues a postponement notice within 6 weeks and 1 day of her start date, informing her that the assessment has been postponed until the 8th of May. The postponement notice will also inform her that she can request to join the pension scheme at any time and how to do this. The 8th of May falls into the 1st to the 31st of May pay reference period. So in May's payroll, Caroline will be assessed based on her age as at the 8th of May and her qualifying earnings payable in May. Her May qualifying earnings are £750 as she took several weeks of unpaid leave. So although she meets the age criteria, her qualifying earnings are too low, so does not meet the eligible job holder criteria and is not automatically enrolled. Caroline returns from unpaid leave in early June. Her qualifying earnings for June are £2,000, so above the monthly earnings trigger of £833. The first day of a pay reference period is always an assessment day. Based on her age as at the 1st of June and her qualifying earnings for June, she is assessed as an eligible job holder. The Payroll Bureau, using the postponement rules set by the employer, applies postponement again, this time to the start of the following month, the 1st of July, and issues another postponement letter accordingly. In July, Caroline's qualifying earnings are £2,500, and so when assessed at the end of postponement, 1st of July, she is an eligible job holder and is therefore automatically enrolled into the scheme. The employer cannot postpone her again. The employer issues a letter informing Caroline she has been automatically enrolled as at the 1st of July. The letter will also explain about the contribution rates, tax relief method and the right to opt out. The employer has 6 weeks to issue the enrolment letter, so in this example, no later than the 11th of August. For more information on postponement, please see the guidance on our website. I'm now going to hand over to Joe to take you through compliance and redeclaration.
Thanks, Andy. We have noticed that some employers are late in submitting their first redeclaration of compliance, or the information supplied is not always correct. We have updated our website to make the process easier and more accessible. I'm now going to demonstrate the process of completing your redeclaration of compliance online. Though not all the steps are included, we hope this will be helpful to you, especially if you haven't as yet used the new process. Firstly, go to our website and access the Declaration of Compliance page. On this page are the links to the declaration and redeclaration checklists if you need them. Otherwise, you can log in as a guest or sign into your account. If you do not have an account, you can create one here. Enter your email address and password to log in, and your client's dashboard will be displayed listing up to 200 clients. Clients are listed in declaration date order with the nearest at the top. If you have more than 200 clients, no list will appear. However, you can search on the letter code, PAYE reference or employer's name. You can add a new client from here and utilise the facility to bulk upload multiple declarations and redeclarations of compliance. Select the client you wish to complete the redeclaration for. The redeclaration duties task list for your client is then displayed, showing what steps are still to be completed. In our example, we have already completed the pension scheme and PAY information steps. In the About You step, please enter the name and full contact details of the person completing the redeclaration. This is important in case we need to get in touch. Please ensure you enter the re-enrolment date. Even if you have no one to enrol, you must enter the date. Next, you are asked if anyone was re-enrolled. In our example, no one was. And the final step we show is staff details, where the number of staff employed, number already in a qualifying scheme, and number of other staff are entered. If you've said yes to having re-enrolled staff, then you will need to also enter the number re-enrolled in the staff details section. All the numbers need to be accurate. Please ensure you complete all the steps in full and redeclare on time. The deadline for completing the first redeclaration of compliance is 5 months after the 3rd anniversary of the employer's duties start date, with subsequent redeclarations being due 5 months after the 3rd anniversary of the previous re-enrolment date. We recommend that as soon as the payroll, which includes the re-enrolment date, is completed, the employer, or you on behalf of the employer, completes the redeclaration process. Where an employer doesn't redeclare or redeclares late, they are very likely to be fined £400, with further penalties of up to £10,000 per day if it is not resolved. It is therefore very important that the redeclaration is completed on time and accurately. I'll now hand over to Andy, who will talk about directors.
Thanks, Joe. Directors was one of the areas that you wanted us to explain in more detail. We'll work through an example shortly, but to summarise, the key points are: if a director is not employed by their company, they are exempt. If a director is employed but no one else is, they are also exempt. If an employed director is not exempt and becomes eligible to be enrolled or re-enrolled, the employer may choose not to enrol them. It's important to understand that the employer's choice regarding directors applies only to the duty to enrol and re-enrol. All other duties remain unchanged. For instance, they need to be informed that they have the right to join the pension scheme. Let's look at an example of a director-only company. Peter sets up a company as a sole director and he is employed by his company. No AE duties apply to single director-only companies. Business is doing well, so he appoints another director, Sarah. Sarah is not employed by the company. Although the company is no longer a sole director company, only one of the directors is employed. There are no other employees, so the company is still excluded from AE. Business continues to do well, and another director, Vimal, is appointed. He too is not employed by the company, and so the company is still excluded from AE. Business is booming, so Peter appoints another director, Linda, who is employed by the company. There are now 2 employed directors, and therefore the company now has AE duties. The employed directors now come under AE and need to be informed that they have the right to join the pension scheme. However, the employer can choose whether or not to enrol or re-enrol employed directors. The employer will now have a duty start date. This will be the employment start date of Linda, and the employer will now need to complete a declaration of compliance within 5 months of this date. For more info on director exemptions, please see our website. I'll now hand over to Joe to talk about changing pension schemes.
Thanks, Andy. Your feedback to us asked if we could cover where an employer chooses to change pension schemes. This is an area that requires careful thought and planning. We would expect the following to be considered: all interested parties and internal departments involved early on, a comprehensive project plan, due consideration given to the most appropriate effective date for the change and its impact, for instance, where there is more than one pay frequency, how the scheme closure will work, a full understanding of the new scheme's rules and requirements, good and comprehensive communications with all staff, especially those enrolled into the current scheme, which may include the requirements for a full consultation process to take place if the employer has more than 50 staff. Systems and processes tested and ready for the change. Normally, the transfer from one scheme to another would be a contractual change, where the new scheme would start immediately after the old scheme closed, so that there's no break in pensionable service. If not a contractual change, then an immediate re-enrolment duty would apply, where all job holders in the old scheme would need to be automatically enrolled into the new scheme immediately following the old scheme ending, so there is no break in pensionable service. It's very important that the change is carried out correctly and seamlessly. We're now going to look at some future changes to workplace pensions. Last year, the Pensions Extension of Automatic Enrolment Act 2023 received royal assent and enabled Parliament to make changes to the automatic enrolment rules. The changes are the age at which you can be automatically enrolled or re-enrolled being lowered from 22 to 18, and the lower earnings threshold being abolished. The Department for Work and Pensions will launch a consultation on implementing the new measures, giving you the opportunity to feed back on when and how the changes will be made. Please watch out for its publication. Once the details are known, we will issue guidance for employers and for organisations such as you. Turning to pensions dashboards, I'm sure you've read about this in the trade media, but I wanted to take this opportunity to talk to you about the role you can play. AE has meant that more people are saving into pensions than ever before, and from an early age, which means that most people will end up with more than one or two pots. We know that keeping track of multiple pots can be tricky. People don't always let schemes know when they move home or change name, and this has resulted in a big increase in lost pension pots over the last few years. PPI Lost Pension Survey 2022 shows the scale of the problem. It shows that over 2.8 million pension pots are considered lost, an increase of 73% between 2018 to 2022. And while I was unsurprised by the increase, given the impact of AE, I was shocked to see the average value of a lost pot is not hundreds, but thousands of pounds, an average of £9,470. A significant amount for a saver to be unaware of. The objective of dashboards is to help people to reconnect with lost pensions and show information in one place, and from there they can seek advice and guidance and plan for retirement. There are around 3,200 pension schemes in scope for dashboards, which between them cover more than 42 million savers. As well as workplace pension schemes which are regulated by TPR, the duties also apply to group personal pension schemes regulated by the FCA. Savers will register to a dashboard and, once their ID is validated, a bit like you do for online banking, their personal information will be shared with schemes and, where a match is confirmed, relevant pension information securely returned. With schemes expected to connect to dashboards from next year, there is significant work taking place behind the scenes right now, with schemes and those supporting them getting their systems and processes, and importantly their data, ready for their connection. Data is the lifeblood of a scheme and is fundamentally important to the success of dashboards, so that schemes are matching the right people with the right pensions and returning the right information to dashboards within the expected timescales. Pensions dashboards have the potential to revolutionise the way that people engage with their pensions. There's an important role for all employers to play by ensuring they are keeping schemes and providers up to date with changes in personal data. As you'd expect, name, date of birth, address and national insurance number are all critical fields for schemes to use to match information provided through a dashboard with data they hold in their scheme. You as business advisors can provide support to employers to enable them to play their part by ensuring that the data that schemes hold is up to date and accurate. To find out more about what schemes need to do and how you can help, read our guidance and then talk with your clients about how you are able to support them in providing up-to-date, accurate staff data to schemes. Finally, we'd like to focus on avoiding scams and how you can prevent your clients and their employees being caught by a scam and losing their pension. TPR leads the Pension Scams Action Group, which is a multi-agency task force tackling fraud and scams. The task force brings together law enforcement, government and industry, working together to provide valuable intelligence to law enforcement agencies, giving a clear picture of the scale of the problem. High-profile prosecutions have helped send scammers the message that we and our partners will take tough action to stop their criminal enterprises. In 2022, following a TPR prosecution, 2 fraudsters were jailed for a total of 10 years for their part in a £13 million pension scam. I'm happy to say that our pledge to combat scams has over 600 organisations signed up. If you haven't signed up, please visit our website for the link and make the pledge to combat pension scams today. Fraud accounts for almost 40% of crime in England and Wales, and on average only 34 reports of pension scams are received each month. Our recent campaigns focus on reporting as the best defence. To find out about the warning signs of a scam and how to stop savers being scammed, visit our website. Many thanks.
We'll now give you a couple of minutes to submit your questions. Welcome back and thank you for submitting your questions. Our first question is from Shiva, who has asked, when a company's PAYE scheme is due to close and there are no employees, how should we inform the pension regulator? And that would be a good question for Joe.
Well, thanks Shiva, thanks Lisa. So it's very important that you inform us where a company is no longer an employer. We do have a facility for this via our website where there's a portal and you can declare that the company is no longer an employer on there. As a backup, we obviously operate a contact centre as well. So if you or the company want to call us and give us that information, that's another way that you can let us know. It's important that you do tell us that they're no longer an employer and indeed that the PAYE has ceased, because if we don't have that information, then we would be looking to that entity to re-enroll at the next correct point. We'd be issuing communications in that regard, and of course the company might risk regulatory action if they don't re-enroll when we're expecting them to. So as I say, we use there is a portal on our website which you can declare that entity to be not an employer, and as a backup please call the contact centre.
Great, thank you. Our next question is from Anchor, who has asked, can I change a standard pension scheme to a salary sacrifice pension scheme? And Andy, would you be able to answer that?
Yes. Okay. I think first thing then, salary sacrifice is where the employment contract for an individual has been changed. So the individual is saying, yes, I agree to have less salary in exchange for an additional employer pension contribution. So you are changing, instead of having an employee and employer, you're now going to have all employer contributions being paid over to the pension scheme. So the first thing to do is contact your pension provider and say, this is what we're thinking of doing, can we do it? How do we go about doing that? And secondly, depending upon where you get your legal advice from, maybe internal, maybe external, look to see how you can implement a salary sacrifice arrangement for your pension into your company, so that you get the right setup for the salary sacrifice to be in place as an employer, and also that the pension scheme is an agreement. And then of course you can change it from an appropriate effective date and start making those payments over.
Great, thank you Andy. Our next question is from Jacob, who has asked, if we have previously submitted a company as not an employer on the basis that there is a sole director or a number of directors without an employment contract, and then they employ a member of staff at a later date, what next steps would we have to take, and what would be the timescale in which those steps should be done? Joe, would you be able to answer that question?
Yeah, thanks Lisa, and thanks Jacob, and good to have this one because it's almost the reverse scenario from Shiva's question earlier. So I'd assume in this scenario that they've never employed anybody before. This is the first member of staff that the organisation has employed. We'd obviously regard that as the duty start date for the organisation. Clearly the company would be in the business of setting up a PAYE, by which means they'd be able to pay that member of staff. We do have access to data, so eventually we would see the PAYE data and identify the member of staff, and we'd issue the company with its welcome pack. But some initial steps that I think would help the company would, at the same time as setting up the PAYE, they may well want to explore setting up a pension scheme if they haven't already got one, and of course assessing that member of staff as to whether they're eligible or not. In terms of timescale, obviously obviously to say that the first date of employment would probably be the duty start date in this scenario, but of course postponement applies, as we covered earlier in the webinar as well.
Great, thank you. Our next question has been pre-submitted by video.
Good afternoon. I'm Christine Scott, Head of Charities and Reporting at ICAS. As an accountancy body, our members may be impacted by auto-enrolment requirements as employers or advisors to employers. I'd therefore like to ask what practical steps employers, particularly small and micro employers, can take in order to remain auto-enrolment compliant when circumstances change. For example, when a growing business appoints new directors or when the scope of the auto-enrolment regime changes.
And Joe, would you be able to answer that question for Christine?
Yeah, thanks Lisa, thanks Christine. So there's a wide range of support and information available to small and micro employers. There's obviously professional bodies like yourselves. Other trade bodies often carry in their press updates on pension or employment matters as well. Clearly, the pension providers have a clear role in this, and they often issue regular updates to their clients around any changes to automatic enrolment or scheme issues like that. Payroll providers as well will often publish newsletters or updates to their clients. And of course, there's TPR's own website, and in particular the employers page under the automatic enrolment area, which is a place to look for further guidance and advice to employers. I think certainly the best thing they can do is just keep abreast of those matters. Ultimately, they can either contact us as well if they want to do that, as I said, in relation to an earlier query.
Great, thank you. Our next question is from Sandra, who has asked, an employee was postponed from auto-enrolment but has now been made a director with no contract before the auto-enrolment date. Do we still have to complete the declaration of compliance? Andy, would you be able to answer that question?
Okay, so I probably need more information really. So if the employer has got a duty start date, and hence they need to do declaration of compliance within 5 months of that duty start date. So if they've got other employees, then that duty start date is going to continue. And if this is the only person who's been employed, was an employee, and that's why they've got a declaration of compliance duty, because that's the duty start date. Now they've been postponed and then they become a director before the automatic enrolment date, which I assume means before the end of postponement. So, but they had an employee, so they have a duty start date. So they therefore have a duty to declare. It would be nil. But it's just, I've got a lot more thoughts, but I'm not entirely sure. Depends on the circumstances. So maybe email back in and we can take it away, maybe, possibly, just with more data about exactly what it is you mean by that. Sorry, great. Sandra.
No, that's great. Thank you, Andy. So Jeff has asked, please confirm when new employers are written to with their TPR 10-digit number. Joe, would that be a good question for you?
Thanks, Lisa. Thanks, Jeff. Yes. So obviously, as I mentioned in relation to an earlier question, once we're aware that a new employer has duties, we will be writing to them with a welcome pack. So depending on the information we have available to us at that time, that might be a time at which they are given or allocated their 10-digit number. But don't forget, we also rely on materials such as PAYE scheme numbers if they have any particular, also a reference from their pension scheme provider, a number there as well. So we will use sort of multiple sources to try and make sure we've identified the correct employer and we can communicate with them effectively.
Great, thank you. And Julie has asked, are seasonal foreign workers treated the same under auto-enrolment rules? Are there any exceptions? Joe, a question for you to answer again.
Thanks, Lisa. Thanks, Julie. So, in principle, automatic enrolment applies to workers who are ordinarily working in the UK. So, no, there's no essential change in approach for AE just because they happen to be seasonal or overseas workers. Don't forget, as we said earlier in the webinar, of course, postponement can be applied to such workers. We do give in our detailed guidance on the TPR website under the AE section specific examples involving workers from overseas who may have come over here and carried out work either seasonally or for longer terms. There is a specific example, I think, which very much matches your question in our detailed guidance.
Great. Our next question has been pre-submitted by video.
Hello, this is Tim Middleton from the PMI. My question is, what advice are you giving to scheme managers about members with LTA protection given the imminent abolition of the lifetime allowance?
Thank you. And Andy, would you be able to answer Tim's question?
Thanks, Tim. Thanks for the video. Yes, I think lifetime allowance protection, really, that's the scheme managers, scheme administrators I would expect most information to come from HMRC. I know that they've been in touch. You know, they've had the last year they issued the LTA abolition paper. There's obviously a policy team at HMRC as well. So I think that's the best protocol for questions for scheme administrators on LTA. Obviously, from an automatic enrolment perspective, someone who's got lifetime allowance, tax protected status, and so on, the employer can choose whether to enrol or not enrol them into a scheme still. So that is still an exception that's applicable from an automatic enrolment perspective. But in terms of the scheme administration, LTA, etc., then HMRC, I think, is the key contact point.
Great, thank you. And Marianne has asked, do employer duties under auto-enrolment start on the date that an employee starts with a business? Joe.
Thanks, Lisa. Thanks, Marianne. Well, again, assuming, as we did in the earlier question, that the business hasn't had any employees before, we would treat that as the duty start date in respect of AE. Now, as I said before, we will have access to data. We should be able to see that employee in PAYE data. And we offer tailored communications then straight out to the business. Depending on what stage it is that we then are made aware that they have an employee or a member of staff, will dictate which welcome pack we issue. So we issue one of 3, and those welcome packs will set out for the business what steps they need to take to be compliant and secure compliance with their automatic enrolment duties.
Good. So the next question comes from Anna, and Anna says, I have been having difficulty finding clear guidance regarding employer contributions for a variable hours weekly paid employee receiving statutory maternity pay, and asks what is the correct calculation method and calculation period for employer contributions. Andy, would that be a good question for you to answer?
Why not? Right, so several thoughts. So what we're saying here is, first point is that employees pay contributions based on the pay they're receiving during maternity leave. Employer pays it based on the pay the person would have had they not been on maternity leave. And of course, you're quite rightly saying, what happens if the variable pay, that pay is fluctuating all the time? So what is the right amount of money that the person would have had they not been on maternity leave? Legislation doesn't actually specify a method. So what is an appropriate method is for the employer to determine, and probably using current methods of calculating average pay would not be unreasonable to choose. So for instance, how you calculate the higher rate maternity pay, you know, the 8-week earning period prior to the end of 50th week, prior to the end of week of confinement. So that sort of calculation, you know what I mean by that if you're in payroll. Or maybe how you calculate holiday pay. So some current method, possibly government-based, to determine what an average pay would be. Then you can utilise that for your for the period of time that the individual is within paid maternity leave. So the 26 weeks. And then the additional 13 weeks. So those whole up to 39 weeks while they're getting SMP, that's all going to be treated as the employer paying on the pay they would have had there not been a maternity leave. Also, they'll look at the scheme rules, because if scheme rules or maybe the employment contract require greater contribution than just basing it on average pay, then you need to make sure you understand that and put that into place. And even after the 39 weeks ends and you've got up to 52-week maternity leave, those remaining 13 weeks where there's no pay, but maybe there is something. So see if the scheme rules require a contribution or the contract requires a contribution. They're my thoughts on that. Hopefully that helps.
Thank you. Yes. Our next question comes from Jane, who asks, are bonuses and overtime always pensionable? Andy?
No. It's the simple answer to that one. Bonuses and overtime will always be qualifying earnings. And of course, you add up all the qualifying earnings, someone gets paid within a pay period, and if they trigger and the right age, they get automatically enrolled. But when they are automatically enrolled, the pension scheme rules then take over, and the pension scheme rules determine what is pensionable pay. So if the pension scheme rules say that basic pay only is pensionable, then overtime and bonus won't be. But if the pension scheme rules say that they are, then they will be. And taking a logical example, if the pension scheme rules say that pensionable pay equals qualifying earnings, then you know that bonuses and overtime, as well as commission, salary, wages and statutory payments are all qualifying earnings, therefore they're all going to be pensionable.
Thank you. And Pavan has asked, do I need to auto-enrol someone who is state pension age? Joe, would you be able to answer that question?
Yeah, thanks Lisa, thanks Pavan. Again, relatively simple answer to this one, which is no. The state pension age is not changing under the new automatic enrolment expansion legislation we mentioned earlier in the webinar. So although the lower age is coming down from 22 to 18, the upper age will remain at the state pension age. So the short answer is if the person is of state pension age, then no, they don't need to be automatically enrolled.
Thank you. And Ben has asked, one of my clients has identified that we have been deducting employee contributions on pensionable earnings instead of qualifying earnings for their employees. He goes on to ask, what do we have to do and where do they stand if they haven't paid enough contributions to their pension provider? Does the pension provider have to work out the shortfall, if there is any, for Ben's client? Andy, would you be able to answer that question?
Yes, I'll do my best, Ben. So what we're saying is, I think what you're saying is that the pensionable earnings that have been set up within the payroll system aren't correct. And in fact, the scheme uses the definition of pensionable pay as qualifying earnings. So you've got some pay elements which should have been pensionable but haven't been. And because of that, the amount deducted for employee contributions, the amount calculated for employer contributions is less than it should be. And you've now got a shortfall. The pension scheme aren't going to know what that shortfall is. They're not going to be able to calculate. Only you've got the payroll records. So really it's a case of tracking back to find out how far back it goes, working out all the underpayments, get those employer contributions paid over, liaise closely with the pension scheme to make sure everything's in sync so you're all working together, helping each other. The employee contributions will obviously be underpaid as well. So we would be looking to the employer to pay those missing employee contributions, but if not, then the employee will need to pay them perhaps in instalments, certainly, but discuss with the pension scheme as to what has to happen with the employee contributions as well. So liaise with the pension scheme and work out all the steps and obviously fix it going forward so that you're not continuing to accrue arrears, and then look to sort out the backlog and work out a process getting that money calculated and paid over.
Thank you, Andy. Our next question has been pre-submitted by video.
Hi, I'm Sam O'Sullivan and I'm the Policy and Advisory Lead at the Chartered Institute of Payroll Professionals. I wondered if there is any further update on the extension to automatic enrolment which achieved royal assent last year in September. Any updates would be really helpful, which would allow payroll software providers and employers to prepare for the changes prior to them being rolled out. Andy, would you be able to answer Sam's question?
Sam, thank you for that. Oh, that's a lot, isn't it? So let me think. So the proposed changes are 22 down to 18 for the age at which it can be automatically enrolled, re-enrolled, and the abolition of the lower threshold. So from an employer perspective, if you've got a scheme, pension scheme where the pensionable pay is defined as qualifying earnings between the lower and upper thresholds, obviously that lower threshold is going down to nil, so therefore the employee and employer are going to pay more contributions, going to go into the pension scheme. And if you're an employer who's got a young workforce, then obviously there's going to be a bit of a spike of work whenever that legislation comes in. So there's quite a bit of work there from an employer perspective. I think also it's more than just the age and the lower threshold going. There's going to be changes. So payroll software can make those parameter changes relatively easy. But what about all the letters that come out? Because the entitled worker category will go because the threshold is being abolished. So people will always be opting in. So it will never be entitled worker requesting to join. It will be someone, an individual saying, I want to be in the scheme, and it'll be an opt-in, and there will be an employer contribution. So the letters are going to change, logically. I think also the software is going to have to think about what the help text says, support for the clients, so how you're going to educate and help your clients know what it is they need to do, and also your customer support teams to understand what the changes are. DWP are going to consult. They've said they're going to consult on this, so we wait to see what that is, and let all of us feed back into the consultation so that however it's implemented is really effective. DWP will obviously notify us of the timing of these changes, but once we know what the changes are and the timing, etc., we'll be able to communicate with yourself, Sam, CIPP, with employers, with pension providers, with other payroll providers, with advisors, and so that everyone knows what's going on and how it's going to work. So watch this space, I guess, really.
Yeah, thank you. Our next question is from Sylvia, who has asked, is each future re-enrolment window based around the previous re-enrolment date? Joe, would you be able to answer that question?
Yeah, thanks, Sylvia. Yes, so the important point to note here is that the further re-enrolments will be based on the third anniversary following the earlier re-enrolment date. So, for example, if an employer re-enrolls on the 5th of October 2021, go forward 3 years, 5th of October 2024 is the re-enrolment date, or second wave re-enrolment date, and therefore the window would open on the 5th of July and then close on the 4th of January 2025, so giving that employer the 6 months within which they would need to further re-enroll.
Great, thank you. And Elizabeth has asked, does every PAYE scheme have to have a workplace pension set up, even though there are no eligible job holders? Andy, would that be for you to answer, do you think?
Okay, yeah, certainly. Sylvia, so first of all, was it Elizabeth?
It's Elizabeth.
Sorry, Elizabeth. I do apologise, and Sylvia. So first of all, it's not. Don't worry about PAYE schemes. It's about employers. Employers have the duty. So if they've got someone to enrol, then they need to have a scheme to enrol them into. Or if someone, so in this case, you haven't got anyone to enrol at the moment, but they may decide to opt in or request to join. And if they do that, then you need to get a scheme ready for them to be enrolled into. So if you've got no one to enrol, my advice would be search, find out what scheme you're going to choose, and then when you've got the requirement to put someone in the scheme, you know what scheme you're going to choose, and you can then set the scheme up and get the individual into the pension plan.
Great, thank you. And Jill has asked, what is TPR's process for dealing with delinquent employers? How and when does TPR escalate to court action? For example, if Jill has a client who has not paid over contributions, what happens in that scenario? Joe, that might be a good question for you to answer.
Yeah, thanks Lisa, thanks Jill. So as many of you on the webinar will be aware, TPR reissued its code of conduct earlier this year. We republished a consolidated single code which is much more accessible now to users, to trustees, to work out what their duties are. But it's important to note that the reporting duty on schemes did not change under the code. So schemes are still obligated to report missing contributions to TPR immediately if they suspect dishonesty or fraud, and in any event at the 90-day point when those contributions are outstanding. So we will receive those reports. We have bulk and automated enforcement processes for chasing down those missing contributions direct with the employers, and of course they're liable to fines and penalties if they don't respond to us or if they take too long to rectify any missing contributions. As I said earlier, we have criminal powers in TPR. We have prosecuted in the past. We do prosecute clearly dishonest activities by employers. And it's important to remember that the fraudulent evasion of the duty to pay across pension contributions is a specific offence under pensions legislation. Now, in terms of advisors, those working with such employers, clearly there's an ethical consideration for those employers. You can take advice from your professional body in that regard. Depending on the relationship, it might be appropriate to challenge that employer direct if you're aware of seeing something untoward happening and you have some suspicions. And as I think has been mentioned earlier as well in the webinar, we obviously operate a whistleblower hotline as well, which may be available in those circumstances where suspected dishonesty can be reported direct to us. And as I say, we'll then be launching an investigation into that employer and taking the appropriate steps.
Thank you. And Debbie has asked, to confirm please, is a director's wife, non-director, without an employment contract, either written or implied, also classed as exempt from auto-enrolment? Andy, that might be a good question for you.
Thanks, Lisa. Thanks, Debbie. Yeah, so what we're saying here is that the wife is not a director and not an employee. So the key is whatever work they're performing for the company, is that as a truly self-employed person? Because if it is truly self-employed, then the person is exempt. If, however, it's not truly self-employed, actually they are a worker. So not an employee, but you can still be a worker. And if you are a worker, automatic enrolment duties do apply. So you need to look at the relationship between the wife and the company to determine what is that. Is it self-employed or is it worker? And self-employed, no. Worker, yes.
Okay, great, thank you. And Francoise has asked, when do you have to inform TPR where mistakes have been made in regards to incorrect pension contributions? And Joe, that would be for you, I think.
Yeah, that's a good one. Thanks, Francoise. So I would say tell us straight away, but probably the better course of action will be to inform the pension provider in this regard. So if it's been a sort of honest mistake around the quantity of the contributions due, inform the provider, because of course the provider is expecting a certain amount of contributions to come through based on any data that they have from the employer. So if a mistake's been made, declare it to us, declare it to the provider. The provider will normally allow you to make up any arrears either instantly over a short period of time. And again, once you've reported to us where we see an honest mistake like that, we will allow a period within which the employer can then backdate any missing contributions or any errors made in the calculation of those contributions, and we can assist the employer with that if you contact us direct. As again via the website is probably the best way to do that, and let us know there's been a mistake. If you've informed the provider, normally the provider is able to take care of that within their own processes, and you wouldn't be reported to us. Otherwise, if that does happen and the missing contributions are notified to us, we'll allow you to backdate those contributions and rectify the situation with the provider. Thank you.
And Katrina has asked, should the minimum hourly rate for hourly or salaried employees match the national minimum before or after salary sacrifice? Andy, would that be a good question for you to answer?
Yes, Katrina. I think what you're saying is national minimum wage. Can you salary sacrifice national minimum wage or not to below national minimum wage? No, you can't. So national minimum wage is national minimum wage. You can't go below that. Of course, national minimum wage is actually quite a complicated thing because it isn't just hourly rate. It's based on, like, if you're weekly paid, is have you paid the right amount in the week, you know, for the hours worked versus the amount paid. So it's more complicated than that. But as a simple level, if you're paying national minimum wage and you're salary sacrificing, then you're paying less than the national minimum wage, and chances are you're going to be in breach of national minimum wage legislation.
I'd like to take this opportunity to thank you all for joining us today and for sending in your questions. I hope you found the session useful and informative. As mentioned earlier, a set of reference slides are now available to download, along with our useful links document, and a replay of this webinar recording will be accessible in a few days' time by navigating back to this page. We really appreciate your feedback, so please complete the survey and have your say. As a reminder, you can find this in the menu on the left-hand side. And so now it's goodbye from us.